investment strategy that suits or aligns with your investing goals? Well, I'd like to welcome Adam Lampe, CEO and co-founder of Mint Wealth Management. Adam, welcome to the show. And maybe we could just start right from the top. Why is it important to find the right strategy to meet your investing goals, Adam?
Well, thank you for having me on, but I think it all comes down to your investment policy statement. Your big institutions have that, and I encourage, investors to have an investment policy statement because I always remind folks, we want to look at risk. And a lot of folks tend to look at return. And I would say that's secondary because I can have two portfolios with the exact same return. And the one with the lower risk will have a better end result or more money for you. So you got to look at your time horizon and your liquidity needs and your taxes. Now, if your basic needs are covered by your Social Security and your pensions, then you can be a lot more aggressive. And I think that is really important to take into consideration because there's mutual funds out there that, yes, they are very cheap. They might be 0.15, but they are terribly inefficient on an after-tax basis. So you have to really take that into consideration. And, as Jeffrey Gundlach said, ETFs, there's some risk out there. They've grown to over 5 trillion, and there's some liquidity issues. Back in 2015, when the market went down about 6%, some of the ETFs went down about 40%. So I encourage folks to follow the rules. I've answered a ton of questions about GameStop and all kinds of things that don't really matter in the scheme of things. I want folks to take advantage of the tax code. I mean, Mitt Romney, he's notorious for his tax return. His tax return, I think he uses every, code in the IRS book, and he's done very well for himself. So taxes and risk are probably the biggest things that we really need to focus on. Mutual funds work, but I also like individual stocks. Stocks are amazing to have because we can control what our dividends are. I mean, tech has been, incredible last year, but this year it's really struggled. And so, it's frustrating for me to see folks get away from the basic rules of finance.
Got it. Now, obviously, having that first step of an investing plan put together, very important first step. But then once you're by that and it comes to sort of choosing investment strategies or constructing an investment plan, how does one typically go about that?
Well, that's a great question. I mean, we want to look at, whether you're in the accumulation phase or you're in the retirement spending phase. We have to look at your cash flow. We have to look at all those different things. And, like I said earlier, individual stocks can provide some predictability because, like for instance, AT&T, as far as I'm concerned, every investor should own AT&T. In the last 20 years, it's paid a dividend between 4 and 7%. I'm not a big fan of annuities. A lot of times annuities, they have 4 or 5% in expenses, but yes, they offer a guarantee. But I like AT&T and I like other stocks, but I only like them up to about 3%. It only takes one person to ruin a good company. And then, of course, a lot of people haven't heard the concept tax alpha or tax harvesting. And we always want to be sensitive about that because, if you manage your portfolio, especially in an after-tax way, you can actually increase your value by 10 or 20% over a period of years. So it's a big deal. And then we also want to avoid overlap. It's frustrating for me when I see a lot of folks that have, Apple or Google in multiple different accounts, and it does nothing for us on a risk-adjusted basis. So we want to be aware of that, and we want to follow the basic rules of finance. And again, I would say risk management is more important than return. I mean, that's the thing that I think a lot of people should really focus on, because if you have stable employment and you know what you're putting away, I always tell folks when they decide to work with a financial advisor, they shouldn't be worried about anything besides staying married if you're married and spend what you say you're going to spend. But if you do have a trusted advisor in your life, you can rely on them and get good advice and not take on too much risk. I think in the last year, a lot of folks, they feel really good about themselves. I mean, I met with a gentleman this morning and, his account's up 62%. He's a client. We're taking risk off the table. Because we know that everything goes through cycles, and you have to rebalance your portfolio as well. Because a lot of times people just set it and forget it, and I think that is a crucial error that they can make.
Well, that was just bringing up one of my next points, Adam, is that once you've got that investment plan, as you talked about, in place, and you've determined your goals and aligned everything up. What happens if a strategy that might be right today changes over time? What should investors consider about changing their strategy as they either get older or they get closer to meeting their goals and things like this, Adam?
Well, large value stocks provide some stability, for people in retirement, and things change. There's a difference between strategic asset allocation and dynamic. Dynamic, you take advantage of things, and a lot of managers are focused on more large value, and that's because it provides income. I think it's very important to know. Like I gave the example AT&T earlier. It pays 4 to 7%. And, I think a diversified portfolio takes about 90 different positions. And, it only takes one person to ruin a good company. But I think, as long as you follow basic rules of finance, and you have to understand that the market is we just went through our shortest recession ever. The market went down 34% and then came back basically in a month, and that's remarkable given there's only been 12 other times during the stock market that the market's been worse than the last 12 months ago. So I think you have to be agile. You have to be willing to take advice. And you have to be careful because if you buy a mutual fund on a personal basis, you could get hurt with tax issues, even though you technically didn't make any money in there. And that goes back to a lot of times it makes sense to own individual bonds and individual stocks and complement them with other things, maybe, a high yield ETF or mutual fund. But I'm a big believer in individual stocks, and mutual funds play a part. But at the same time, at a certain point, we have to be wary of, our tax situation, especially if you have after tax money.
Okay, well, Adam, thank you very much. Those are all great takeaways for long-term investors. Again, that was Adam Lampe, CEO and co-founder of Mint Wealth Management.